I'm going to hold my gold bar anyway because I'm not interested in a free profit. Then that is a signal that trust is collapsing. And if trust collapses, then the system's in deep trouble.
Mhm.
So what will happen at the end is gold will go into permanent backwardation. That backwardation will be rising probably exponentially, as will the price of gold be rising exponentially at that time. And this is going to be the end of the currency. Most people won't see the spread in the gold market. And if some news commentator on the primetime news were to mention it, nobody would really understand what the heck does this mean. But what they'll notice is the effect on consumer prices, because
Ladies and gentlemen, welcome to the special interview. Today we have a first-time guest to the show, Keith Weiner. Keith is CEO and founder of Monetary Metals, located at monetary-metals. And I got to tell you, it started out as a gold hedge fund and a blog, and it has since moved to a company that has figured out how to make a yield on gold. Is that right, Keith?
that's it, a yield on gold paid in gold. That's our trademark.
Hey, Keith, I'd like to thank you for joining us today on Silver Doctors.
Thanks for having me.
Now, Keith, we hear about, there's going to be a gold rush, and there's going to be retail investors coming into the space, and there's going to be institutional investors coming into the space, because there's basically no denying that the gold bull market is on. There might be some debate back and forth whether we're in some sort of super commodity cycle or not. But in general, a lot of people would just say the bull market restarted in 2015. Now, I just want to get your assessment on how you see the gold market right now, because I'd like to share with you what I'm seeing, and then I'd like to hear what you would have to say about that. Because I see on one end of the spectrum, we have, honest money guys, sound money guys. I would include that as like myself. I'm trying to get people to understand that gold and silver coins in your hand is a way to get out of the system. It's a way for privacy. It's a way to protect against fiat currencies and government run amok. On your end of the spectrum, you're introducing the gold bonds. You've got a yield on gold, and this isn't in dollars. This is actually in gold. These gold bonds are issued in gold, not dollars, if I'm understanding that correctly, and we'll get to that in a minute. But on the other end of the spectrum, this is what I'm having troubles with. I'm seeing all this financialization coming into the gold market. For example, 2 weeks ago, Barclays started an ETN on the NYSE called G-Bug and S-Bug. And all they are is exchange traded notes with exposure to gold and silver prices. And these are zero fee. So it's a purely financialized product. Or on the COMEX, for example, the Shanghai Gold Exchange has renminbi denominated financially settled gold futures contracts. So on one end of the spectrum, we see stuff moving towards, honest money and sound money. On the other end of the spectrum, we see, these highly financialized products. Can you give me an assessment of how you see the gold and silver markets right now? And I know that's kind of vague, so I'll let you take that where you want to take that, Keith.
All right. So first of all, I think it's important to make a distinction between trading for gains and advocacy of honest money. And I certainly think one person can do both. I see nothing wrong with trading for gains per se. As I often, when I talk about our system, I say blame the game and not the players. Blame the Fed for putting us in this game where we're forced to trade for capital gains and speculate. Don't blame the players where they haven't been given any choice in the matter. That said, I think a couple of things. First of all, each person has to decide what's his goal in a particular position. If your goal is to play the price, then you should just be looking for whatever gives you the lowest cost way of playing the price, provided you trust the counterparty and provided you trust that whatever mechanism they've established that their instrument is supposed to track the price, that actually will in fact track the price. And I don't know if I haven't seen these Barclays ETNs in any details. I can't comment on them. Obviously, everybody's familiar with GLD, and so with GLD, you have some counterparty risk. That is, there's a chain of custodians and sub-custodians. It's not clear to me what would happen in the case of one of those entities going bankrupt. Somewhere along the way. And what I have learned, I sold my last company to a company called Nortel Networks. Nortel was the largest bankruptcy in financial history, as far as I know. And what I learned through that process, being a small creditor, is that I didn't know anything about bankruptcy, how it really plays out. It's complicated. Litigation is very expensive. Um, and I believe in the case of Nortel, still ongoing. They filed for bankruptcy in January 2019. Oh, excuse me, 2009. So we're
Wow.
now going on 11 years of litigation on that. So if your purpose in holding GLD was to have gold, and somebody were to go bankrupt in the middle of it, and it turned into a litigation like that, 11 years later, you're still, you're still fighting for something. So, but on the other hand, if you're looking for a quick trade, maybe one of those ETNs is good. We talk all the time about bid-ask spread and cost of carry. So if these ETNs give you something very close to a zero bid-ask spread, the bid-ask spread is your loss if you were to enter the trade and immediately exit. So let's say you wake up one morning and you say, I'm going to buy this. 5 minutes later, you get buyer's remorse and say, I need to sell. Price hasn't moved, but you sell at the bid price and you pay the ask price. What's the difference between the two? That's how much loss you take. Usually the ETFs are much better than physical metal when it comes to that spread. And then, of course, there's cost of carry over long periods of time. So if they offer no cost of carry, that's great. But then you got to ask, what is the counterparty risk? What are they doing? Is their gold physically stored? Usually that has a cost. What are they doing to achieve that zero cost? And are you comfortable to assume that risk in order to avoid that, 41 basis points of cost that GLD has?
Right. And when I read the press release from Barclays, there's no physical goal behind it. It's purely a speculative exposure to price only, which I find very interesting, highly financialized. But yeah, if you're in the spirit of free markets, then it makes sense that, people can do what they want to do. So if they want to participate in these kind of financialized products, that's fine. That would be my opinion. Now, moving on here to the other end of the spectrum, talk to me about a gold bond, because I think what you're doing is important, because we hear oftentimes that we need to kind of stop thinking in terms of dollars, right? And we need to start thinking in terms of ounces or thinking in terms of gold. We talk about bond market, as far as the US government and the debt. And, if you're going to hold a bond for 30 years, is there risk involved with that? What's the dollar going to be worth after 30 years from now? So you have some new concept. Have you actually been offering these bonds so far? Are these still in development right now, Keith?
The first one is in development. We believe to be issued later this year. I was going to joke and I was going to say, no, of course, the government bond has no risk. That is the definition. And regulatory statute says it's the risk-free asset. Of course, there is a risk. And the other thing that needs to be said is right on the Federal Reserve's website, they talk about their mandate for price stability, which is 2% inflation, chronically. And I just have to say, every time I think about that, Orwell would be either smiling down from heaven or grinning up from hell, depending on your perspective, that price stability is 2% inflation forever.
Mm-hmm.
So soon, over long periods of time, that 2% really adds up.
Yes.
So we obviously believe that things are denominated in gold. I've been saying since the very beginning what everybody should do is take your net worth. I assume everybody must calculate that once a month in a spreadsheet of some sort. Take the then current price of gold and divide. So let's say your net worth is, just to make the math easy, $150,000. The gold price is $1,500. Divide, and then you end up with 100 ounces. That's your net worth. And so, you could work really, really hard and take a lot of risk and stress and everything else, and your net worth may go up. But if the gold price is going up as well, you may find that actually your net worth went down in gold terms. Gold is the only way to measure changes in wealth over periods of time. The dollar is too unstable to do it. People try to use prices to adjust the dollar, but I think that's very problematic for a lot of reasons. Mm-hmm. So the whole thesis of a gold bond is that from the investor standpoint, it makes sense to invest in something that is stable money as well as honest money. From the issuer standpoint, from the borrower standpoint, it makes sense if you're producing a gold income. So let's take a gold mining company, for example. If you're producing a gold income, you should be borrowing in the same money that you're producing to avoid the price risk. So if you borrow in dollars and the price of gold goes down, you have this terrible exposure that ultimately can cause insolvency. So of course, the banks that do that kind of lending force the mining companies to hedge, and then the problem is if they hedge and the price goes up subsequent to the hedge, then they have a mark-to-market loss. So that currency mismatch between your asset, which is gold, or your income stream, which is an asset, is gold, and your liability is dollars, is an existential threat to the companies that are financing themselves that way. And by switching to financing in gold, not only do they have a lower cost option, and not only is it more user-friendly, but eliminates this entirely artificial and unnecessary risk, which is the currency mismatch. So the gold bond is a win-win deal. It's better for the issuer, and it's better for the investor as well.
Mm-hmm. And then my understanding is that it also pays the yield in gold as well. So you have the bond plus you're getting some yield like on a yearly basis. Is that how that works?
Yeah,
So
and the bond pays
like
interest.
in a coupon, I guess is what I'm trying to say. The coupon is actually a yield in gold.
Yeah, but the bond pays interest. So if you put in 100 ounces of gold into the bond and the interest rate is 6%, then you get 6 ounces of gold per year as the interest in this. So this is a very interesting thing, and tying to honest money and plotting some sort of path for how we get from here to there. In a lot of my early talks, I used to talk about that gold only goes into private hoards today, and which is a limitless, it's a bottomless pit. No matter how much gold is mined every year, it disappears into private hoards, and it's never enough. If you look back to the late 19th century, when London ran the world's monetary system and the world's commerce, and you look at how much gold did they actually have in London at that time, it was 160 tons. The state of Nevada annually mines more than that, mines 166 tons every year than what London had. And so you didn't need that much gold to run this enormous system. And the difference between then and today is, of course, gold earned interest in those days. So in my early slides, I used to talk about interest being the regulator of flow, and I used to have a plumbing picture that I cribbed off of some plumbing catalog, with like I think it's called a check valve, where if the valve is horizontal to the pipe, it's open, and if it's perpendicular, it doesn't allow flow. Saying this is zero interest rate, this is a normal interest rate, and it was all very sort of abstract and hypothetical, and I sort of had a sense of like an anthropologist today looking back at the old Roman baths or something like that, and they're writing these scholarly works on what would have been common knowledge to any idiot in the Roman Empire would know. Yeah, you go here, you take your sandals off, you go there, you throw your toga down, and you go into the hot water, right? And so we've now, so the theory is interest is the only thing that will pull gold into the market. It's the only force known to man. They can go door to door with machine guns, as I presume that Mao did in communist China. They can make gold illegal as they did in the United States, although they didn't go door to door, thank God. But you don't really get a lot of gold that way. You get a few gullible people or a few scared people. For the most part, you drive the gold underground. It goes into hiding, and people don't talk about it anymore. You can't get rid of gold having value, and you can't pull it out. But if you offer to pay interest on it, a funny thing happens: the gold comes out.
Mm-hmm.
And
Mm-hmm.
so I used to talk about this. There's a quote. I'm trying to dig up the exact sourcing. Supposedly, somebody went to J.P. Morgan in one of the banking crises that would have been either in the 1890s or maybe 1907. And supposedly somebody said, Mr. Morgan, there's a crisis in New York. There's a shortage of gold. What are we going to do? And he said, raise the interest rate. And according to the quote, 4%, he said, we'll draw it off the continent, which in those days of steamships was expensive and slow and risky. 5%, he said, we'll pull it down off the moon. And so what he was speaking to was something that I think any ancient Roman would understand about the baths or how things worked, is that, sure, the higher the interest rate, the more people are eager to put their gold into the market because they're greedy for yield.
Mm-hmm.
And the lower the interest rate, the more people say, I might as well just take my gold back, because if you're only going to pay me 0.5% or 1%, I'm just not all that keen to let my gold out.
Hmm.
And so this all being abstract theory, we've now proven it because we've done a variety of deals in our gold leasing program, which is not a bond, it's something else, but it pays interest in gold. And we can see that interest draws the gold into the market. And some of our deals have higher rates and some have lower rates. And the higher rates, people are a little more aggressive about, take my gold, please. And which is exactly what the theory would expect.
Hmm. That's very interesting because, you know, everybody says, well, gold doesn't pay any interest, and now in a land of ZERP, no interest is better than negative interest, but now you've taken it up one extra level. But let's stay on interest rates for a second because a lot of things are happening. The Fed is engaged in these repo market operations, and they're talking about the very first one. I can't remember if it was like September 16th or the 17th, but they came out with their statement from the New York Fed, and it said, in order to maintain the Fed funds rate and the effective, and this was when it was 2 to 2.5 before they cut again. In order to maintain the Fed funds rate from the effective rate, something like that, I'm paraphrasing, between 2 and 2.5%, we're going to engage in these repo interventions. But my point is this: with interest rates, and back then in the early 1900s, debt wasn't really where it is today. We don't have all of these, unfunded liabilities. We don't have all of these derivatives. Now we have all these unfunded liabilities. Now we have all these derivatives, and the debt keeps growing exponentially, if I could say it like that. Correct me where I'm wrong in this logic here. Now, my question to you is, but the way that we're on a path right now is that, you're saying you can bring gold out with higher interest rates, but governments on a fiat system need lower and lower interest rates all the time just to be able to service the debt. Am I thinking about this right, or am I thinking about this wrong, or can you help me understand interest rates a little bit more, Keith?
No, that's exactly it.
Mm-hmm.
So there's, in 1933, President Roosevelt, obviously everybody knows, certainly watching your show, that Roosevelt made it illegal to possess gold, as in go to prison, felony crime to possess gold. Less well understood is that effectively made the dollar, the currency, irredeemable to U.S. citizens. It was still redeemable to foreign governments until Nixon in 1971. And so let me explain redeemability. This is another one of those things that every Roman would have understood. First, you take off the sandals, you put them here, and then you take off the robe and put it there. So but let's say before the founding of America, you brought money to the bank, money being metal, specifically gold or silver. You brought money to the bank in exchange for some sort of piece of paper, whether it was a passbook or whether it was currency. It was a piece of paper that said, we're going to give you your money back when the terms of this piece of paper are honored, which could be redeemable on demand. It could have been a 1-year time deposit or whatever it might have been. And so the piece of paper was not some sort of magic talisman that was viewed with moneyness. It was an obligation of the bank to return your money when due, and any bank that couldn't do that was called bankrupt or ruptured, and then the law was not particularly forgiving to the equity owners of banks that failed to be able to honor their obligations when presented. And so, over a series of adulterations, to the monetary system, starting with the Coinage Act, Hamilton's Coinage Act of 1792, fixes the price of silver against gold. And so Gresham's law says whichever one is undervalued will come flooding into the market because it's worth more coined into money than it is, in the international market for metal. We're effectively on a silver standard from 1792. 1834, the next Coinage Act reverses it, and then gold is slightly undervalued, and silver is overvalued. So the silver leaves the market, and we effectively become a gold standard. Then there's the period of irredeemability during the Civil War. Obviously, people who accepted Confederate paper lost everything. People who accepted Union paper were eventually made whole, but things were in doubt for several years. Then there was the crime of 1873, where they demonetized silver. And that made the small savers, which are the farmers and the artisans, very upset because their wealth was held in silver at home. The wealthier people had their wealth in gold in the banks, obviously. And so that was a transfer of wealth from the farmers and the artisans to the wealthy interests. That crime continues to fester, and anger and resentment continue to fester, culminating in 1896. William Jennings Bryan, do not crucify this country on the cross of gold. Bryan loses. Where does Bryan surface again after that? The Woodrow Wilson administration. And William Jennings Bryan is instrumental in enacting the Federal Reserve Act. So, so these things don't go away just because they're politically, defeated. They come back they mutate and they come back with a vengeance. And I don't think the farmers who were screwed in 1873 necessarily wanted a fiat paper system with a Federal Reserve that manipulates interest rates. I don't think they were necessarily looking for that, but that's what they got ultimately. Was that 40 years later? Their kids and grandkids had to suffer through that. Point being that I'm sorry, I lost my train of thought.
And my question towards you was, but it's constantly requiring lower and lower interest rates for governments.
Oh yes. So with so long as there is a redemption feature of the currency, then the debt does not necessarily grow exponentially. It can grow if there's an increased opportunity to finance something productive. As soon as you remove the redeemability, you also remove what's called the extinguisher of debt. So today we pay debts in dollars, but the dollar is itself an IOU. So if you pay a debt by passing off the government's IOU, all you do is shift it. You shift it to the government. So it's not possible to pay down a debt. It's only possible to service it. And the debt must necessarily grow by at least the accrued interest in order for the system to hold together. And actually, it has to grow a lot faster than that. Because if you look at all the debtors and you stack rank them from marginal to the US Treasury, which would be the opposite extreme, you have to grow by enough that the marginal debtor can always get more credit to continue to service his debts. And if you don't, then of course the system begins to collapse because then you get defaults, and then defaults beget defaults because they start to blow holes in balance sheets, and then there's a wipeout of what people used to believe was money.
Mm-hmm. And so basically, when it comes to this debt, when it has to keep on growing, at least by the rate of interest, is I think what I just heard you say. The point is that mathematically it has to end up in a hyperinflation. Is that correct, Keith?
Well, what we have right now is a cycle of falling interest rates, which drives falling prices. And we don't necessarily see prices falling as much as they would, because I've written a series of articles on this. The regulators and the taxinators keep imposing more and more useless ingredients. And so, so for example, in dairy production, you might think, what does it take to produce dairy? Well, you need a little bit of land, and you need some cows, and maybe some labor, and you need a glass jar, and that's, you get a bottle of milk. And they come along and say, well, now we need supply chain management, and now we need proof of vaccines, and we need ADA bathrooms for workers. And so you start adding all of these ingredients that are legally mandated that the consumer of milk doesn't know about, doesn't care about. And so the price of milk goes up, and people say it's inflation, and they blame the Fed. It isn't monetary. From a monetary perspective, falling interest rates drives falling prices because it incentivizes the next marginal entrepreneur to borrow and expand production, and so what you get is overcapacity everywhere. Mm-hmm. And so that trend continues for a while until eventually the system becomes so unsound that people begin to distrust the counterparty entirely. We saw this occurring for the first time in December of 2008. And so what happened was a phenomenon called gold backwardation. The backwardation is when a commodity has a lower price in the futures market than in the spot market. So think about this for a minute. Suppose I have I'll just use my hotel key card here as a proxy for a bar of gold. I have a bar of gold. If there's backwardation in the market, what that is saying is I can simultaneously sell this bar of gold to the market and buy a futures contract to get back the same 100 ounces of gold plus a risk-free profit. It's, as conventionally defined, it's risk-free. Of course, there is a risk, and that is what if the system fails? What if the banking system is going down in flames and they start to declare force majeure and all those things? And so it's really important to watch this because if participants in the market are now en masse rebelling against the system by saying, I'm going to keep my, even though you're offering a free profit, I'm going to hold my gold bar anyway because I'm not interested in a free profit, then that is a signal that trust is collapsing. And if trust collapses, then the system's in deep trouble. So what will happen at the end is gold will go into permanent backwardation. That backwardation will be rising probably exponentially, as will the price of gold be rising exponentially at that time. And this is going to be the end of the currency. Most people won't see the spread in the gold market. And if some news commentator on the primetime news were to mention it, nobody would really understand what the heck does this mean. But what they'll notice is the effect on consumer prices, because there's an interesting asymmetry here. That is, while those who own gold at that moment of backwardation are no longer interested in bidding on dollars, those dollars, of course, are going to be not only interested in getting gold, but I would say increasingly desperate to get the last little bit of gold through the window before it's shot forever. And so those who have dollars, when they find that gold is no longer available for sale for dollars, somebody's going to discover something, and that is, if I trade my dollars for crude oil, gold will bid on crude oil. Even though it's not bidding on dollars, it'll bid on crude oil. And so what that will do is people will say, oh, look, that worked. And then they will drive the price of crude oil up to infinity, dumping it. They're not interested in crude oil. They're just interested as a conduit, a backdoor channel to get into gold. So every liquid commodity will be driven to infinity, not because of printing money to infinity, not because of inflation per se, but just simply as this is the last way to get a few last ounces of gold before the whole system shuts down. And they'll drive the prices of everything to infinity in the process. People will call it hyperinflation. People will say it's the crack-up boom that Mises talked about, which I think is sort of largely right. But whatever you call it, the system will then fail. People will say the dollar is done, stick a fork in it.
Mm-hmm. And, I wasn't alive during when Nixon closed the gold window, and obviously didn't use silver coinage from the 60s. And, they don't just say Nixon closed the gold window. Another way that they say it, they call it the Nixon shock, right? So that was a Sunday evening. It was August 15th. So I guess my question is, and I guess there's two questions here. Do you see some sort of, I don't want to call it a Trump shock or whoever the president would be at the time, but do you see some sort of presidential shock coming again, only instead of being about gold, it's about the dollar? And are we close to that if you see one? And then the second question is, when we get to that point where the currencies fail, well, that would imply that there's going to be a crisis on Main Street as that's going on. Does that not, Keith? So let's take those questions how you went there.
Yeah, I mean, as things continue to grind their way down, and I use down as an analogy a lot, that it's not a death by the super hot thermonuclear explosion of hyperinflation that we're currently facing. It's more like the cold, lonely death of drowning and zero negative interest. Interest rates are negative in many countries around the world. We're lucky in the dollar. We still have a positive number sporting on our 10-year bond. Of course, this is very harmful to the average person. While those who own assets, particularly those who own assets with borrowed capital, are loving it, those who work for wages and those who have to somehow try to save their wages. So when I started my career, the standard advice was set aside 10% of your salary, put it in the bank, and by the time you turn 65, I think the number was you'll have $1.5 million on average. And that 1.5 million would be enough to live in retirement. Well, that 1.5 million that you had 44 years later, if you did this with discipline, most of that, I think 85% of that was the compounding of the interest, and only 15% was the actual raw amount that you took out of your paycheck and put aside. And so, of course, with zero interest today, the average wage earner cannot ever achieve his long-term goals of retirement or anything else. So we already see this huge dichotomy, this disparity between the exponentially rising wealth, at least on paper, it isn't real wealth. They call it the wealth effect, and I like to use the analogy that the wealth effect is wealth in the same way that pasteurized, homogenized American cheese food is cheese, which is to say it passes a superficial, resemblance, and that's about it.
Yeah.
So, absolutely, what will be going on Main Street will be a worsening of what's already going on. 96 million people today don't have a job, but they're not counted in the unemployment statistic because they're officially not in the workforce. And so if you statistically sweep everybody aside, you can say, well, look, we have the lowest unemployment rate ever, but it's just a sleight of hand. That continues to grind on, as obviously the government continues to borrow money to somehow feed and house these people. They're not going to allow, humanitarian crisis in the United States until the government can no longer, fund it.
Mm-hmm.
That continues to grind on, and things get worse and worse. And then, these types of crises are nonlinear events. Everything's seemingly okay until one moment abruptly they're not. And that happened in 2008, and that'll happen again for sure.
Yeah, and I look back just to last week in Chile as an example, and the word coming out of Chile is that they raised the price of public transportation in Santiago, and that was the tipping point. And then there's riots in the streets, and 8 people were killed because they're not using water cannons and tear gas; they're using actual rifles without rubber bullets in them. So yeah, because I wanted to get your thoughts on that because this is going to be a scramble either way because, if you don't have a job and if the dollars are losing their value, that's like a double whammy in and of itself, if I'm understanding that correctly. So what it also makes me think is that all this talk about MMT and monetary theory, it's coming regardless because if what we're going through is this, then, like you said, the government's going to step in with the humanitarian because if not, there will be riots and looting and chaos in the streets. Is my logic correct there, Keith?
You mentioned modern monetary theory, which I wrote an article and I called it a cargo cult. In World War II, the U.S. military set up some forward operating bases, I guess, in certain of these Pacific islands, and they pressed the locals into service to carry the cargo out of the planes and whatever, and they paid them in like cans of beans and spam and stuff like that, which for those local people was incredible wealth. They had never seen product like that. World War II is done. The U.S. military pulls up the stakes and leaves, and most people now were missing the cargoes, which had become, their livelihood. So these elaborate cults evolved on some of these islands where they put on these coconut, headphones, and they had tiki torches and imitation of the flashlights to go through all the motions of, trying to summon. They thought it was like a magic ritual of like summoning planes with the cargoes. And of course, it didn't work, and those cargo cults, I think, in some cases, persist to this day. So I wrote an article calling Modern Monetary Theory a Cargo Cult. So somebody brought to my attention a tweet from, I don't think she is the originator of modern monetary theory, but she's now sort of the darling poster child of it, Professor Stephanie Kelton, who was cited by Alexandria Ocasio-Cortez as, so MMT is part of the Green New Deal, so-called. Mm-hmm. And so this Kelton had tweeted that a football stadium can never run out of points, and a carpenter can never run out of inches, and the U.S. government can never run out of dollars. And I was trying to find the actual. I only saw a JPEG of the tweet. I was trying to find the actual tweet, and what I wanted to respond to her was, "And a cargo cult never runs out of coconuts." I didn't, and then it turns out her tweet was old and it wouldn't have been worth it. But I think that. In my take, trying to take the longer view, there are various degrees of unsound, dishonest monetary shenanigans as you deviate from standard, which is honest money. You have the monetarists that pay some respect to reality and reason, although I think deviating from moral rectitude certainly, and also soundness of money. And then the Keynesians are worse, And then the modern monetary theorists are even farther off the deep end than the Keynesians, but I see it as a continuum. They're all promoting the same voodoo, the same idea that the government can create money, can order the tide back, and then they have varying degrees of restraint. And MMT basically says, restraint, we don't need no stinking restraint, man. We can do anything we want. And it's almost shocking in how pugnacious it is, that sticking the jaw forward or putting the chip on the shoulder. The question is, are people so jaded to it that they just accept this as the next increment, or does it actually generate any real resistance? That is yet to be determined.
Mm-hmm. Yeah, that's very interesting. Thanks for sharing that. One thing that I am curious about, and I think you're the perfect person to ask for this, because I'm not sure if you favor if we were to go back on a gold standard, my understanding is that you would not want like fixed weights and measures like the Coinage Act of 1792. I'll hold that thought for a second and let you address that if you want. I could be wrong on that assumption there, but here's my question. Gold right now, a lot of people don't know this. I don't know if it's 81 or 8,300 or whatever the amount of tons is. I mean, I don't think it's there, but that's another story. But the US Treasury holds gold, and the statutory rate is $42.22 an ounce. It's actually like 42.2222. So here's my question to you, because in the gold community, a lot of like people talk about like a reset or global reset or a debt reset or a monetary reset. But the Treasury holds gold on the books at $42. So I have a question I'd like you to explore, if you could, with three different scenarios. What would happen to like the U.S. debt or the dollar, or just however you want to approach this question? What would happen if the gold on the Treasury's books was priced at a market rate, right? So let's call it $1,500, and that market rate fluctuated. And then the second question would be, what would happen if the gold on the Treasury's books was statutorily priced at $10,000? And then what would it look like under $100,000? And since you're both an economist and a mathematician and an expert in gold and all these things, I think you're the great person to answer that question, Keith.
Well, thank you. I think, number one, the price of $42 is just the law of accounting, going back to Luca Pacioli, who's the one who first invented or discovered double entry accounting back in the Italian Renaissance. The law of assets says you book an asset at the lower of either market price or acquisition price. And so they're just holding it on the books because that's where it was when when the gold standard ended, and for whatever historical reason, it was bumped up from 35 in the last days of, before Nixon or right around that time. I don't know the exact events that went from 35 to 42, but
I think it was 70 in 1974. But anyway, continue.
So they revalued it at 42. But that said, I think that's just accounting, law and really nothing more than that. That said, markets aren't stupid. Assuming that people believe that the U.S. government has the 8,000 tons, which is a separate question, then the market is capable of doing the arithmetic of knowing what the price of a ton is today. And so if the government were to announce that we're going to rebook it at $1,500 an ounce, I don't think anything would happen. I think it would be a giant yawn. Now, if the government were to book it at 10,000, I think they could potentially create some big ripples in the gold market, because I think that could fuel and set speculation on fire that something is going to happen. If the Federal Reserve said, we stand ready to buy gold at $10,000 an ounce, they'd probably buy an awful lot of gold. A lot of people would be lining them to sell it because there'd be a giant capital gain, and people can go and buy, Ferraris and luxury yachts and penthouse suites and stuff like that with their gold. But that said, I don't think central banks actually have the power to fix the price of anything in the long run. And so, of course, everybody's familiar with, banana republics that try to peg their peso, 1-to-1 to the dollar. And what that effectively means is when the market is testing them on that peg, which it always does sooner or later, when the market's testing them, that means that the market is selling pesos and therefore the banco de banana, as I call it in my writings, then has to buy pesos and sell dollars. And so, at the process of depleting their reserves until they can't anymore, and then it fails, and then they announce that the peso is now going to be 5 to 1 or whatever. And this happens in Argentina, every few years. This happens in a lot of Latin American dictatorships. But there's also now a recent example of a peg in the other direction, and that is the Swiss National Bank attempting to hold the franc not up, but down. And so in the case of holding it up, it's pretty clear that when you run out of dollars, you can't do that anymore. But everybody believed, conventional theory holds that you can hold it down because you have access to your own printing press. And so you can just print as many francs as you need to, and you can hold the franc down to 1.2 francs of the euro. They didn't want to go above that for a variety of reasons. Well, it turns out that failed also. It failed very spectacularly in January 2015. And when it snapped violently, they finally had to abandon it. The Swiss National Bank lost something like 20% of Swiss GDP in a millisecond. And so, of course, in my view, what central banks do is not printing, but borrowing. And so they're creating a liability. That's why the Swiss National Bank ultimately had to abandon it. They're borrowing francs in order to buy euro-denominated assets. And as the market is pushing the euro down and the franc up, then that means their liability is going up and their asset is going down. They hit their stop loss. They hit the point where the board must have met, and they were looking at each other saying basically the equivalent of, "Oh shit, what are we going to do?" And somebody said, "Well, we've got to pull the plug, because if we continue to go any further, we can end up being bankrupt, and that would be humiliating." And so they had their stop loss. So you can't peg something like that. And so if the Federal Reserve were to attempt to peg the dollar to gold at 10,000, I think they would create a huge crisis, as that's clearly not the right market price today. They'd create a huge crisis that would ultimately, either they would have to abandon it and abandon their credibility, or continue forward with the crisis. That said, I realize this is very controversial in the gold community, and yet I remain unrepentant in my view, and that is, I don't think anybody in the mainstream actually cares about the price of gold. I've met a number of central bankers, not at the Bernanke and Yellen level or the Jay Powell level, but I know a number of them and have met and discoursed with many of them at 1 to 2 levels down from that. And I guess what I have to say is, number one, they're not necessarily the smartest people in the room. I mean, they're just like regular people like anybody else. And I liken it to what kind of person is capable of designing and engineering a race car versus what kind of person is capable of driving it. These are operators for the most part. They don't necessarily understand how the system is put together. And when they write theories, as Janet Yellen did, and I took it apart for a Forbes article, the theories are frivolous. I mean, almost laughable. Like, if I was an economics professor and somebody submitted that as a paper, I think I would say D-. Like, okay, I can't fail you because you put in hard work, but this is really terrible. And so in my Forbes article, I called her whole thesis frivolous. I don't think they really understand gold or money. I don't think they care. And one of my articles, I think this was when I responded to Tad Butler. He said he wanted thoughtful disagreement, and so I published a paper with a great deal of disagreement, and whether or not you call it thoughtful is up to you, I suppose. And it generated a lot of controversy, and GATA was going back and forth with it and everything else. And I responded in saying, I just don't think they care about the price of gold anyway. And so then a lot of the old quotes of what Secretary Connolly and others were saying in 1971 period, let's call it 1971 to 1975, were trotted out. And I said, look, Nixon said that the closure of the gold window was temporary in his speech. And so nobody knew, even after 1971, for a couple of years, nobody really knew, well, is he going to undo it? Is he going to issue another presidential directive that says, okay, we're reopening the gold window, what will the new price be? And so it took a while for first of all, the political system to work through, no, we got away with it. Hey, we're all good. We got away with it. We don't have to. And for everybody to figure out gold didn't matter anymore. And so you had a series of Fed chairmen who got farther and farther away from gold. Of course, the next chairman that everybody knows about is Paul Volcker, appointed by Carter, and then working hand in hand with Reagan in his first administration. Volcker wrote his doctoral dissertation on real bills in the gold standard. So there was a guy who obviously grew up in the first part of his career, and his academic career he knew about gold. Greenspan, of course, follows Volcker. Greenspan knew a lot about gold and wrote a lot about gold in an Ayn Rand book in 1966. Subsequent to that, you had Bernanke, who majority of his professional career would have been in the post-gold era, had never studied gold, never really thought about it. Yellen, obviously, the same way. Now Jay Powell. And so the world has moved away from, I just don't think they care anymore.
Mm-hmm.
And why should they? Gold is just another chip in the casino for betting on the price action to make more dollars. And when you make more dollars, whether it's on antique Ferraris or whether it's on shares of WeWork stock or whether it's on gold, then you pay more taxes.
Yeah, I like your analogy of the other drivers, and they're terrible drivers. But but now I want to get to the care about, because I find that interesting. You say you don't think the central bankers care about gold. So I'm not here on the economist level like you are. So let me bring it down to like the alternative media level where I am for a second, if I could, Keith. I would agree with you in that sense. And I know what you say is controversial. And I mean, everybody's controversial in the gold and silver space. You can't be in the space if you're not, right? But I look at it like this. When I think about people, not central bankers, but people, and not thinking about it or not caring about it, I think of it like my own personal theory is that it's kind of like those sea turtles, right? And those sea turtles, they hatch in the beach, but they instinctively know how to get to the ocean. How do they know how to do that? It's like in their genes or something. So I think that just the regular people, right? Just us as humans in general, I think that gold and silver is something that throughout all these generation after generation after generation, thousands of years, is somehow hard coded into our genes that we know gold and silver is money. And very much to the same token that those sea turtles can hatch on the beach and know how to get to the ocean instinctively, I think that there will come a point in time where this kind of like switch is flipped, and then humans get it again, and we say we got to go back to gold and silver. So could it also? How do you assess my logic there? And could it also be that they don't care about gold and silver right now because it's dormant, according to my theory about that? Or what do you think about that, Keith?
Well, I think there was somebody who quipped. I don't remember if it was Henry Hazlitt or maybe H.L. Mencken, who said there's some things that are so brain dead that only a PhD could. No, maybe it was Thomas Sowell. Only a PhD could possibly screw up his brain enough to believe it. These people are PhDs usually in economics from all the best schools, Harvard and Berkeley, Janet Yellen's from Berkeley. I think they're armed with a theory that tells them that gold doesn't matter. And, of course, in the financial system today, people observe. I'll share an interesting anecdote with you. I gave a talk last year at an Austrian economics conference at King Juan Carlos University in Madrid. And so it's a bunch of Austrian scholars there. There's some pretty big names there that you'd recognize. Without getting into the names, the first speaker and then myself, the first speaker said only gold is money and nothing else. And they gave him a very hard time and said, what do you mean? I mean, look at all the buying and selling, look at GDP, look at the market, look at global trade. Are you saying we don't have any money? It's all barter. They just couldn't understand what he was saying. This is a bunch of Austrian school academics and scholars that couldn't get their head around the idea that the dollar isn't money, it's something else. And I took the same premise. I said, I'll defend that. And then I explained what I meant. And I didn't get the same hard time that the first speaker did. But I think that, people just accept that dollar is money. And if you say the dollar isn't money, you're controversial, even in Austrian circles. Now, just imagine Chicago or Keynesian circles or neoclassical circles. They just...
Blasphemy.
Well, it's not even blasphemy. It's just like, it's just regarded as a frivolous, idea that's not to be taken seriously. And so they just laugh at it and they move on. And one of the things for which I am controversial is, and essentially what I try to do is I try to say to my ideological friends and allies, we could be making more effective, we could be making stronger arguments. When we say the Fed is private, we just get laughed at. When we say these things, it's a Rothschild conspiracy and all this kind of stuff. I know some people believe that stuff, but when you say that, you're just laughed out. So I think one of the problems that gold has, if I would just try to put on my branding and marketing hat for a moment, is that there's a lot of unserious things that are said, and so I think the mainstream people can lump it all together. Flat Earth, and steel doesn't melt. Fire doesn't melt steel, and the Rothschild conspiracy, and all these things, and gold, and they just lump it all together and just say, oh, come on, the inmates are running, the asylum over there, and of course it's just a shortcut or a short circuit. Then they don't have to evaluate any of the ideas, some of which do have merit. And so, the idea that their system is failing because there's no extinguisher of debt, and the two failures are really, one, debt grows exponentially because it must, and two, the interest rate is completely destabilized and it's been collapsing for 40 years. Those are two theoretical things that can't be argued against. And the fact, if you just look at the official published numbers, the interest rate has been falling for 40 years, and the debt has been growing exponentially since 1971. But those things can get lumped in with all the rest. So I don't think they understand the need for it. Obviously, and this is Upton Sinclair, who I'm not a fan of, who said it's impossible to teach a man something that his salary depends on him not understanding. And so they stay in their little paper world because that's where they have power and that's where they have everything that they want in life. And to them it's pretty good. So I'll give you an anecdote. I was at an event, the Shadow Open Market Committee event, sponsored by the Manhattan Institute. So even the fiscal conservatives, when it comes to the monetary issue, support irredeemable paper money in a central bank. So they had Dick Fisher, who was at that time president of the Dallas Federal Reserve, as the keynote speaker. And I don't remember what Fisher spoke about. It didn't stick in my mind, but I remember the Q&A, because one person said, what do you think of the wealth effect? So economists talk about the wealth effect. GDP tends to go up when assets are going up because people feel richer, so they spend more money. So he says, well, let me tell you. And he's a charismatic guy, looks like a fun guy to have a beer with. He says, the wealthy have been very affected. And, the room is full of one percenters, and the people in the room who weren't one percenters were academics that were probably hoping to go through the revolving door of academia to government and then a bank. Everybody in the room gave that little golf clap. And I'm sitting here thinking, you SOB, you think what you're doing is transferring the wealth from the poor and the middle class to the 1%, and you're okay with that. And it's actually worse than that. In my writing, I talk about the consumption of capital and the wealth effect is an illusion and all these things, but that's what they think. And that quote really demonstrates that everybody in the room was on board with that. Why do they need gold? This is working for them just fine. And it isn't working, but they can't see it. They won't understand it until it actually crashes. And by that point, then they'll figure, well, we'll just find another game to play or something. But that's the context to my statement.
Mm-hmm. Well, thanks for sharing that, Keith. One more topic here, and then we'll let you have some concluding thoughts there. But I wanted to ask you about silver, because it's not just gold; it's gold and silver. And I like it because silver is mentioned in the U.S. Constitution right there with gold just as well. So I just wanted to ask what you think about silver in general, but I also wanted to specifically ask about the gold to silver ratio, because to me, the gold to silver ratio right now is one of the most, I don't know if I would call it a no-brainer opportunity, but the gold to silver ratio arbitrage that's presenting right now, I mean, if you think that it's going to revert and overshoot a historical mean and go to 40, well, that's a free ounce of gold from where it is now. If you're selling your gold and buying silver at 80, and then you're selling your silver and buying gold at 40. So I just wanted to ask you, like, what do you think about silver? How do you think silver plays a role in the monetary system? What do you think about the gold to silver ratio? How low do you think it's headed? When is it headed there? And I just threw a lot at you. So however you want to run with it, Keith.
I think that silver is money also, which raises a number of interesting sort of theoretical points, which is markets tend to be winner take all. Why two metals? And people say, well, these metals are very similar. They're both heavy and shiny and good electrical conductors, and they're both malleable and so forth. They serve different purposes. They grew out of different needs. And, none of that's really changed. So in my particular sort of sub-school of economics, hoarding is an important thing. And, Mises and a lot of other economists have been pretty dismissive of hoarding. But I think hoarding is really important because hoarding is when people take, I guess you call it stacking today, but people take metal home and hide it for all the reasons you started out this interview with, in terms of privacy and, sheltering something from rapacious governments, but also just simply in terms of risk, mortality in the human condition. There's, the time immemorial, people want to do that. If you were working for wages as a typical sort of middle blue collar worker, so not unskilled minimum wage labor, but not highly skilled. You're not the supervisor on an oil rig making $300 an hour, but you're sort of a middle, skilled machinist or something like that, or carpenter, and you want to set aside 10% of your wage and put that into metal every week. Gold is impractical. I mean, in terms of taking it home. You can get a digital account, and those things can become very effective for small quantities of gold because you can digitally fractionalize gold, and you can buy it down to a fraction of a gram if you want. But if you want to take some piece of metal home, gold is very impractical and becomes very expensive. You can buy a 1/10 ounce gold eagle, and then there's other things that go down to even smaller than that. But you pay a huge premium for gold manufactured to those tight tolerances and a very wide bid-ask spread. And so again, the bid-ask spread being the measure of your loss from buying and selling, if you're the wage earner, that loss is critical. So if you want to set aside, let's say $50 a week, let's say that's 10% of your wage. You want to set aside $50 a week. If you want to buy gold, first of all, there's the loss, and secondly, the amount of gold that you'd get, if you wanted to put that in your pocket, I mean, you'd lose it in the lint. It's too small to, it's a tiny little wafer. Whereas $50 of silver is 3 ounces, roughly. So it has some heft, it's 3 big chunky coins. It's a lot more satisfying to just simply have. And I think silver will continue to serve that role, not only today, but, indefinitely into the future, as the way for wage earners to save, part of their wages. And gold serves a different role, and it's not just simply a larger denomination. Gold has a smaller bid-ask spread, so in terms of big transactions, that spread, matters. But silver has a smaller spread for wage earner-sized, transactions, buying a grocery or setting aside, let's say 10% of the week. So that said, I think silver is still money. And oddly, that puts me at odds with a lot of the silver folks, including Mr. Butler, because their contention is that the silver stocks have been consumed down. If that's so, then what they're arguing is that silver has been demonetized. Silver is no different from platinum or rhodium. I believe that's not true, that vast stocks of silver are out there, which is exactly how you'd expect money to behave. That it's not consumed, it is held for its own sake, as certainly is the case with gold, and that anytime somebody tries to corner the market for silver, so the Hunt brothers famously tried to do that in the late 70s, Warren Buffett famously, or maybe slightly less famously, tried to do that in the late 90s, what they find is that there's a hell of a lot more silver out there than they reckoned. You can't just look at, COMEX bars. People start melting down the candlesticks and the, and the silver T services and stuff. And if the price gets high enough, more and more and more silver comes flooding into the market as a deluge, and that proves that it's still money. It still behaves like money. People store their wealth. Those T services, I don't know how many people are buying T services today, but people don't generally melt them down. They continue to hold them and have them, and that's a part of the family's wealth, and it always has been.
Very interesting. Thank you for that. And do you see the gold to silver ratio? Do you have a forecast on that, or you don't have a forecast on that?
So, you mentioned hedge fund. We still operate a hedge fund, and that's what we trade is the gold silver ratio. The mean of the gold silver ratio over a very long period of time is in the 50s. So if there's a mean reversion, that's going to be a big gain, for people that own silver in preference to gold today. You also referenced something that I believe typically occurs when something gets stretched this far away from the mean, and then finally whatever is holding it that far stretched snaps. It doesn't tend to just go to the mean and then stop gently. It will tend to overshoot in the other direction. And so I do think that silver represents the relative bargain right now. What's interesting is, and you didn't ask me about this, but now it sort of comes up, the gold market's in a very funny place because, we talk to institutional investors around the world, and we also talk to both retail investors and retail bullion dealers. And what's very odd about this market and the run up in price, it's about a $200 run from $1,300 roughly in May to $1,500-ish, that it hit in August, is that was largely not only without retail participation, but selling at retail. That was the retail folks are bringing in their coins in small bars, cashing out, saying, I had a chance to get out without taking the big loss. I get half my shirt back. And meanwhile, institutional money is coming into gold for a variety of reasons, and obviously it's because they think that either there's going to be a great inflation or a great crisis. Versus, and that's why this price rally has had greater legs, I think, than all the other rallies post 2011. The price would blip up and then it would just subside, and that's because it was just speculators in the futures market, or in some cases the stackers would get excited and there'd be some rumor that there would never be any follow through. Now it's institutions that are buying and retail that's selling. So of course, at some point, retail is going to wake up to this and stop selling, and maybe even start buying, and then that could take the price from $1,500 to $1,700 or something like that, or maybe even more. The other thing is, of course, retail has more propensity for silver than institutions do. But what's interesting to me is that in just personally conversations that I've had, I've heard a number of institutions say, do you think silver makes more sense? Do you think it's a better relative bargain? So even the institutions who never would have wanted to buy silver historically are looking at a ratio, and a lot of those conversations I had going back, let's say a couple of months, the ratio was 90 to 1 or something. At 90 to 1, even the institutions are looking at that and saying, surely silver is the better buy at this point. And I'm like, well, look, I can't tell you when the ratio is going to revert, but at a 90 to 1 ratio, it's hard to imagine anything can go wrong buying silver. And for that matter, even at 84.
Very interesting. I think my personal, where I would switch to only silver is above 70. Now, just in closing thoughts here, there's so much going on in the world. There's so much going on in the markets and the economy. Just what's going to be on your radar as we move into the end of the year, and what can you leave our viewers and our listeners with as the most important takeaway you'd like them to get from our discussion today, Keith?
So what's on my radar right now is incipient crisis in credit markets. So you mentioned September 17, the Fed was obliged to intervene in the repo markets. So repo is a very interesting market because it shouldn't be possible for there to be a crisis there, just as it shouldn't be possible for gold to ever be backwardated. And so when things happen that shouldn't be possible by conventional theory to happen, then those are interesting things. So the Fed intervenes, and now the Fed is obliged to continue to intervene indefinitely because otherwise there'd be a crisis and banks are paying 8 or 10% for repo. Repo should not be possible to be in crisis because it's not only is it securitized or secured lending, it's actually a purchase-repurchase agreement. So I have a treasury bond or treasury bill, let's say. I want to borrow from you. I sell you the treasury bill at the market rate with an agreement to buy it back tomorrow at the same price plus one tick up. So you get a little bit of interest with the transaction. And so you're not taking any risk. You're simply buying a treasury bill. The fact that you're not able or willing to lend it to me indicates there's a crisis there. And so I just published an article in Town Hall Finance saying, this isn't just a plumbing problem. There's something serious here. That was a reference to that all the articles that came out that day, the media felt obliged, even barons of all places felt obliged. Before they told you what had happened, they were immediately saying, nothing to see here, folks, move along. It's just plumbing. Don't worry about it. Keep calm and carry on. And, I thought it was very curious. And obviously that signals there is something, very, very wrong. There's a lot of places where credit could blow up. People are pretty familiar with, I imagine viewers of your show are pretty familiar with the yield curve and how it inverted, and now supposedly everything's fine because it de-inverted again. We'll see about that. Third place I think I would look is the spread between junk and treasuries. A variety of ways of doing that. If people are familiar with the FRED website, which is published by the St. Louis Fed, you can look at the spread between the 10-year and the 2-year, the 10-year and the 3 months, and so forth. So that's the yield curve. You can also look at the what do they call it? The Bank of America Merrill Lynch option adjusted. I forget what the full name of it. It's the spread between junk and treasuries. When that starts to blow out, that means that people are selling junk to buy treasuries. That has tended to be a rising thing over the last couple of weeks. It's been falling again as the Fed keeps tamping down each little crisis as it erupts. But at some point, if we go into full-blown crisis, that's going to blow out again, as it did before 2008. So those are the things I would be looking at right now. Oh, and of course, the gold basis itself, which we track and we publish every day. You look to see if gold is moving towards backwardation, which at the moment it isn't.
Keith Weiner, I'd like to thank you for joining us today on Silver Doctors.
Thank you.
And I can't remember where I was going to go with that. Okay, this is what I was going to say.